What if I told you that the key to successful investing has nothing to do with what the company sells, who the CEO is, or what the financial news is screaming today? What if the secret to making money in the market, in the frenzied bull runs of a decade ago, the gut-wrenching crashes of today, or the sideways chop in between, simply came down to a single, easy-to-read chart pattern? It sounds too simple, right? The modern financial world is obsessed with complexity. We talk about discounted cash flows, algorithmic trading, macroeconomics, and the Federal Reserve. We're told that to win, you have to be the smartest person in the room with the fastest information and the most sophisticated model. But this relentless pursuit of complexity is exactly what leads most investors to panic, buy at the top, and sell at the bottom. Today, we're going to break down the philosophy of a man who cut through all that noise with one simple, elegant, and timeless solution. His approach doesn't require a finance degree or a Wall Street terminal. It only requires the discipline to read a chart and the patience to wait for the right phase. Welcome to Capitura. Today, we're exploring the definitive guide to profiting in every single market environment. Stan Weinstein's secrets for profiting in bull and bear markets. The author and the book's background. The man who gifted us this wisdom is Stan Weinstein, a legendary money manager, financial newsletter writer, and technical analyst. Weinstein wasn't famous for trading obscure, tiny stocks or predicting geopolitical shifts. He was famous for developing a clear, systematic trading methodology that anyone could understand and apply. He codified a belief that the price action of a stock tells you everything you need to know, often well before the corporate news or the fundamental analysis catches up. The original edition of this book came out in 1988, a time that feels prehistoric to the modern investor. There was no internet, no smartphones, and definitely no commission-free trading. If you wanted a stock quote, you often had to look it up in the newspaper. To place a trade, you had to call a broker. Yet, this book's wisdom is more vital now than ever. Why? Because while the tools have changed, the fundamental driver of price, human psychology, has not. Stan Weinstein's system is built on the simple reality that stocks move in cycles, driven by the alternating forces of accumulation, smart money buying slowly, and distribution, smart money selling slowly. These cycles manifest themselves on a chart in 4 distinct phases. Weinstein's entire method is about identifying which of the 4 phases a stock is in, because each phase requires a different action. If you use the wrong strategy for the wrong phase, you lose money. If you follow the map, you can consistently profit, regardless of whether the broader market is a bull or a bear. Why the book still matters. A modern shield. In today's chaotic market, Weinstein's book serves as a powerful shield against FOMO and meme stocks. When a stock like GameStop or AMC skyrockets in a week, the noise machine screams. By now, you'll miss out. A Weinstein-trained investor ignores the hype and looks at the chart. Is the stock just entering phase 2, the healthy breakout, or is it already in the dangerous parabolic blow-off of late phase 3 or phase 4, the crash? The system forces you to act with logic, not emotion, against passive investing anxiety. Millions of investors rely on low-cost ETFs and index funds, the core of the FIRE movement, but find themselves terrified during a sudden 20% drop. While Graham taught the temperament to hold on, Weinstein's analysis provides a visual confirmation that a downturn, phase 4, is normal, offering a structure to potentially step aside in the market portion of the portfolio and re-enter later, or at least understand why the market is acting the way it is against crypto volatility. The wild, cyclical nature of Bitcoin or other cryptocurrencies perfectly illustrates the 4 phases of accumulation and distribution. A disciplined application of the Weinstein method allows a trader to visually separate genuine breakouts from false rallies and distribution tops, offering a framework for navigating the extreme volatility that fundamental analysis often fails to tame. This book doesn't offer hot stock tips. It offers a map, a systematic, visual method for understanding price cycles. It teaches you to trade the chart, not the chatter. Stay with us, because we're going to break down every secret of the system chapter by chapter. By the end of this deep dive, you'll possess a repeatable methodology to profit, not just in a bull market, but in any market condition. Let's start the journey. Chapter by chapter breakdown. Chapter 1, the winning formula for superior profits. Stan Weinstein starts his masterwork not with complex theory, but with the assertion that consistent success in the stock market comes from following a simple, mechanical, four-step process. He immediately cuts the tie between fundamental and technical analysis, declaring that price is the ultimate truth. The chart reflects the collective wisdom, fear, and greed of the millions of market participants, often before that information is published in a press release or financial report. The four-step formula. Weinstein's formula is designed to be a screening tool, a visual checklist you must use before buying or selling anything. Determine the major trend, the time frame before looking at anything else. You must decide which time frame you are trading in. Weinstein's system is primarily focused on the intermediate to long-term trend. He uses a weekly chart because daily volatility is too noisy and causes emotional mistakes. Your first question is, what is the current trend on the weekly chart? Is it clearly rising, falling, or trading sideways? Determine the stock's phase. The stage analysis, this is the core of the entire system. Every stock is in one of four distinct phases. You must identify the current phase because each phase dictates a specific action. He emphasizes that phase 2, the advancing phase, is the only time an investor should be buying. All other phases are either for accumulating, waiting, or selling. Determine the specific buy-sell criteria. The trigger once you confirm the stock is in the correct phase, phase 2. You need a precise trigger. Weinstein focuses on two key elements, volume and the stock's relative strength RS, compared to the market. A buy signal is typically a breakout from a base, accompanied by heavy volume, and a stock showing superior relative strength. Practice money management. The risk control node system is 100% accurate. The final, non-negotiable step is controlling your losses. Weinstein insists that you must use a stop-loss order, an automatic selling point, to cap your loss on any single trade, often suggesting a maximum of 10% below your purchase price. The goal is to survive the bad trades so you can capitalize on the good ones. The power of this formula lies in its mechanistic discipline. It removes opinion, prediction, and emotion from the process. It forces you to wait patiently for the optimal setup. You are never chasing prices. You are waiting for the evidence to line up. Modern takeaway, the Robinhood problem. Think about the average user on a commission-free trading app like Robinhood. They are often focused on the daily chart or the hourly chart. They are bombarded with news, price alerts, and social media chatter. This focus on the micro time frame is precisely what Weinstein warns against. The problem, an investor focusing on a daily chart will see a 5% jump in a stock that is actually in phase 4, the declining phase, on the weekly chart. They chase the quick gain, buying at what is simply a brief bear market rally. The Weinstein solution, the weekly chart acts as the ultimate filter. It instantly cuts out the noise and confirms the major trend. If the weekly chart of a hot stock is in phase 4, the correct action is simple. Do nothing or short it. The time frame discipline protects the investor from the FOMO of the day traders. The emphasis on relative strength RS is also vital today. With the rise of the FANG/Magnificent 7 stocks, many investors own a stock simply because it is a good company. Weinstein would insist that the stock must be outperforming the S&P 500. If a stock is a fundamentally great business but is lagging the index, it is telling you that the smart money is putting its capital elsewhere. The stock performance relative to the market is a clear signal that should override the story. This first chapter establishes a foundation. Trade what you see, not what you think or what you hear. Chapter 2, the 4 stages, separating the winners from the losers. This chapter is the heart of Weinstein's system. He argues that every stock, commodity, or market index moves sequentially through 4 distinct, visually identifiable phases. Your success depends on recognizing which phase you are in and taking the corresponding action. The 4 stages of price movement. Phase 1. The base or accumulation phase, the time to wait. Visual. The stock is trading sideways, often for months after a significant decline. The price is chopping back and forth and is typically below the key moving average. Weinstein uses a 30-week moving average or 30 WMA. The moving average line is flat. Psychology, this is where the smart money, insiders, institutions, starts quietly accumulating shares, anticipating a future breakout. Public interest is low, and the news is often mixed or bad. Action, Do not buy yet. This is a watching phase. You wait for the stock to show you it is ready. You are watching for 30 WMA to turn from falling to flat. Phase 2, the advancing or markup phase, the time to buy visual. The stock breaks decisively above a resistance level formed in Phase 1 on heavy volume. The price is well above the 30 WMA, and the 30 WMA is clearly sloping upwards. Psychology. The trend is established, and the masses are starting to notice. News is good. This is the most profitable phase for both investors and traders. Chapter by chapter breakdown. Chapter 1. The winning formula for superior profits. Stan Weinstein starts his masterwork not with complex theory, but with the assertion that consistent success in the stock market comes from following a simple, mechanical, four-step process. He immediately cuts the tie between fundamental and technical analysis, declaring that price is the ultimate truth. The chart reflects the collective wisdom, fear, and greed of the millions of market participants, often before that information is published in a press release or financial report. The four-step formula. Weinstein's formula is designed to be a screening tool, a visual checklist you must use before buying or selling anything. Determine the major trend, the time frame before looking at anything else. You must decide which time frame you are trading in. Weinstein's system is primarily focused on the intermediate to long-term trend. He uses a weekly chart because daily volatility is too noisy and causes emotional mistakes. Your first question is, what is the current trend on the weekly chart? Is it clearly rising, falling, or trading sideways? Determine the stock's phase. The stage analysis is the core of the entire system. Every stock is in one of four distinct phases. You must identify the current phase because each phase dictates a specific action. He emphasizes that Phase 2, the advancing phase, is the only time an investor should be buying. All other phases are either for accumulating, waiting, or selling. Determine the specific buy-sell criteria. The trigger, once you confirm the stock is in the correct phase, Phase 2. You need a precise trigger. Weinstein focuses on two key elements: volume and the stock's relative strength, RS, compared to the market. A buy signal is typically a breakout from a base, accompanied by heavy volume, and a stock showing superior relative strength. Practice money management. The risk control no system is 100% accurate. The final, non-negotiable step is controlling your losses. Weinstein insists that you must use a stop-loss order, an automatic selling point, to cap your loss on any single trade, often suggesting a maximum of 10% below your purchase price. The goal is to survive the bad trades, so you can capitalize on the good ones. The power of this formula lies in its mechanistic discipline. It removes opinion, prediction, and emotion from the process. It forces you to wait patiently for the optimal setup. You are never chasing prices. You are waiting for the evidence to line up. Modern takeaway: the Robinhood problem. Think about the average user on a commission-free trading app like Robinhood. They are often focused on the daily chart or the hourly chart. They are bombarded with news, price alerts, and social media chatter. This focus on the micro time frame is precisely what Weinstein warns against. The problem: an investor focusing on a daily chart will see a 5% jump in a stock that is actually in Phase 4, the declining phase. On the weekly chart, they chase the quick gain, buying at what is simply a brief bear market rally. The Weinstein solution: the weekly chart acts as the ultimate filter. It instantly cuts out the noise and confirms the major trend. If the weekly chart of a hot stock is in Phase 4, the correct action is simple: do nothing or short it. The time frame discipline protects the investor from the FOMO of the day traders. The emphasis on relative strength, RS, is also vital today. With the rise of the FANG/Magnificent 7 stocks, many investors own a stock simply because it is a good company. Weinstein would insist that the stock must be outperforming the S&P 500. If a stock is a fundamentally great business but is lagging the index, it is telling you that the smart money is putting its capital elsewhere. The stock's performance relative to the market is a clear signal that should override the story. This first chapter establishes a foundation. Trade what you see, not what you think or what you hear. Chapter 2. The 4 stages, separating the winners from the losers. This chapter is the heart of Weinstein's system. He argues that every stock, commodity, or market index moves sequentially through 4 distinct, visually identifiable phases. Your success depends on recognizing which phase you are in and taking the corresponding action. The 4 stages of price movement. Phase 1. The base or accumulation phase, the time to wait visual. The stock is trading sideways, often for months, after a significant decline. The price is chopping back and forth and is typically below the key moving average. Weinstein uses a 30-week moving average or 30 WMA. The moving average line is flat. Psychology. This is where the smart money, insiders, institutions, starts quietly accumulating shares, anticipating a future breakout. Public interest is low, and the news is often mixed or bad. Action. Do not buy yet. This is a watching phase. You wait for the stock to show you it is ready. You are watching for the 30 WMA to turn from falling to flat. Phase 2. The advancing or markup phase, the time to buy visual. The stock breaks decisively above a resistance level formed in Phase 1 on heavy volume. The price is well above the 30 WMA, and the 30 WMA is clearly sloping upwards. Psychology. The trend is established, and the masses are starting to notice. News is good. This is the most profitable phase for both investors and traders. Action. Buy the stock on the breakout. Hold it as long as the 30 WMA continues to slope upwards and the price remains above it. This is where you make your money. Phase 3. The top or distribution phase, the time to sell/take profits visual. The stock stalls after a large advance. The price starts trading sideways again, often with higher volatility and a wider range in Phase 1. The price is hovering around the flattening 30 WMA. Crucially, the volume remains high but is not leading to higher prices. Psychology. This is where the smart money begins to distribute sell their shares slowly to the unsuspecting public, who are still buying because the price is not falling yet. Public euphoria is high. Action. Sell your position. The smart money is leaving. You sell when the price breaks down decisively through support level formed in the sideways trading range. Phase 4. The declining or markdown phase, the time to short/avoid visual. The stock breaks decisively below a support level formed in Phase 3 on heavy volume. The price is well below the 30 WMA, and the 30 WMA is clearly sloping downwards. Psychology. Fear, panic, and despair take over. This is when the weak hands sell. News is uniformly bad. Action. Avoid the stock entirely. This is a time to be in cash or, for the aggressive trader, to short sell the stock, betting on a further decline. Weinstein stresses that the most common mistake is buying in Phase 3, the top, because the news is so good and the chart still looks strong, or selling in Phase 4, the bottom, due to panic, which is when the stock is closest to forming a Phase 1 base. The correct action is the opposite of your emotional impulse. Modern takeaway. The Tesla/EV hype cycle. The life cycle of a high-growth tech stock like Tesla, TSLA, or the broader electric vehicle EV sector perfectly illustrates these 4 phases for a modern investor. Phase 1, 2010 to 2019, 4 years. Tesla was in an extended Phase 1. The stock moved sideways, saw temporary rallies and crashes, but the 30 WMA was mostly flat. The company struggled with production. Action. Wait. Phase 2, 2020 to 2021, the stock had a parabolic, sustained breakout, driven by huge volume and momentum. The 30 WMA soared upward. Action. Buy and hold. Phase 3, late 2021, the stock stalled. News remained positive, but the price range widened and the 30 WMA began to flatten. Insiders and institutions began selling into the euphoria. Action. Sell/take profits. Phase 4, post 2022, the stock broke down below a key support level and the 30 WMA started to turn down. Action. Avoid. A Weinstein disciplined investor would have ignored the endless news about Elon Musk's tweets and only focus on the weekly chart's trend and phase. By doing so, they would have been positioned to capitalize on the biggest run and, crucially, to avoid the major decline, protecting their capital. Chapter 3. The 30-week moving average, the primary timing tool. In this chapter, Weinstein introduces a technical anchor of his entire system. The 30-week moving average, 30 WMA. This simple line on a weekly chart is the most important filter and timing tool in his arsenal. Why the 30 WMA? A moving average is simply the average closing price of stock over a specified period. Its purpose is to filter noise. Weinstein insists on a 30-week period, roughly 6 to 7 months, because it is long enough to smooth out the daily and weekly noise, but short enough to register meaningful changes in the intermediate-term trend. He explicitly tells the reader to ignore shorter moving averages, like 10-day or 20-day, because they produce too many false signals. IT defines a phase. The relationship between the stock's price and the 30 WMA determines the stock's current phase. Phase 1, base price, is crisscrossing a flat 30 WMA. Phase 2, advanced price, is above the 30 WMA, and the 30 WMA is sloping up. This is a buy zone. Phase 3, top price, is crisscrossing a flat 30 WMA, often followed by a break below it. Phase 4, decline price, is below the 30 WMA, and the 30 WMA is sloping down. This is a sell/avoid zone. IT acts as dynamic support/resistance. When a stock is in phase 2, the rising 30 WMA often acts as a natural support level. When the stock pulls back to this line, it frequently bounces, offering an opportunity to add to a position. Conversely, in phase 4, the falling 30 WMA acts as a ceiling or resistance level, where bear market rallies often stall. The slope of the 30 WMA is arguably more important than the price's position relative to it. A rising slope means the intermediate trend is up. A falling slope means the intermediate trend is down. You should only be long buying when the slope is up, the big picture filter. Weinstein also uses the 30 WMA to filter the general market environment. He applies the same logic to the major indices, like the S&P 500 or NASDAQ. If the general market index is in phase 4, below a falling 30 WMA, you should drastically reduce your exposure, even if individual stocks look okay. You never want to fight the overall tide. He likens this to sailing. It is much easier and safer to sail with the wind, phase 2, than to try to sail against a gale force headwind, phase 4. Modern takeaway: timing passive rebalancing. For the modern investor relying on a 60-40 portfolio split between a broad stock index ETF, like VO or SPY, and bonds, the 30 WMA offers a disciplined mechanism to rebalance with an edge. The problem: traditional rebalancing is time-based, e.g., rebalancing every year on January 1st. This forces you to sell stocks high and buy bonds low, or vice versa, purely based on a calendar, regardless of market valuation or trend. The Weinstein insight: if the S&P 500 ETF is in a clear phase 2 above a rising 30 WMA, the market is structurally sound. You can be more aggressive with your rebalancing, perhaps letting your stock allocation drift slightly higher than 60% because the wind is at your back, the bear market trigger. If the S&P 500 ETF breaks down into a clear phase 4 below a falling 30 WMA, this is a major warning. This provides a systematic, non-emotional trigger to rebalance back to or even slightly below the 60-40 allocation, reducing exposure right before a potentially deeper decline. This uses the 30 WMA as a macro-level risk management tool to protect the overall portfolio. The 30 WMA is not a crystal ball, but is a powerful trend-following tool that keeps the investor aligned with the market's true direction, preventing unnecessary panic and allowing disciplined profit-taking. Chapter 4, Phase 2, The Ideal Time to Buy. Stan Weinstein dedicates this chapter to the only phase where you should ever be a buyer: Phase 2, the advancing phase or markup phase. His message is simple: patience is not a virtue, it is a necessity. You must wait for the setup to be perfect. The Phase 2 checklist. A stock is considered a candidate for buying only when it meets a rigorous 4-part checklist. The price is above the 30 WMA. This is the most basic requirement. The price must be trending higher than its intermediate-term average. The 30 WMA is sloping up. This confirms the intermediate-term trend is firmly established to the upside. If the line is flat, you're still in phase 1 waiting. If it's down, you're in phase 4 avoid. The relative strength is improving. The stock must be outperforming the general market like the S&P 500. When the market is flat, the stock should be rising. When the market is rising, the stock should be rising faster. Improving relative strength tells you the best money is flowing into the stock, signaling institutional sponsorship. The breakout is on heavy volume. The price must have broken above a key resistance level, the ceiling of the Phase 1 base, on significantly higher volume than average. Heavy volume is the proof of commitment. It confirms that major institutional players have decided to buy the stock in size. A breakout on low volume is a warning sign of a false move. Buying tactics, the perfect entry. Weinstein discusses the two primary methods for entering a Phase 2 stock. The initial breakout. This is the most aggressive by point, when the stock first breaks out of its Phase 1 base with heavy volume. The potential return is highest here, but the risk of a false breakout is also highest. The first pullback. This is a safer, more conservative entry. You wait for the stock to successfully break out, and then pull back to test the former resistance level, which should now act as support, or the rising 30 WMA. If the stock holds this support and resumes its move, the signal is much stronger. He strongly advises against buying a stock that is already at a parabolic, extended move far above its 30 WMA. The reward-to-risk ratio is poor, and you are buying closer to the inevitable Phase 3 top. The time to buy is at the beginning of the move, not the end. Modern takeaway: the growth stock paradox. Today's investors constantly pitch growth stocks based on futuristic narratives, AI, biotech, space travel. The paradox is that many of these companies have been in a long phase for decline after a spectacular initial run. The trap: an investor reads positive news about a promising biotech company that has been in a 2-year decline. The news makes them buy. However, a Weinstein analysis would reveal the stock is still below a falling 30 WMA and is showing poor relative strength. They are trying to catch a falling knife. The discipline: the Weinstein investor would ignore the story until the stock can prove it has entered a new Phase 2. This means price must move above the 30 WMA. The 30 WMA must visibly flatten, then begin to rise. The stock must show relative strength by outperforming the major biotech index. This chapter is a masterclass in patience and selectivity. You should view the market as having thousands of opportunities, but only a handful will ever be in the ideal Phase 2 at any given time. Your job is to ignore the 99% of stocks that are in the wrong phase and focus all your capital on the 1% that are ready to move. Modern takeaway: timing passive rebalancing. For the modern investor relying on a 60-40 portfolio split between a broad stock index ETF, like VO or SPY, and bonds, the 30 WMA offers a disciplined mechanism to rebalance with an edge. The problem: traditional rebalancing is time-based, e.g., rebalancing every year on January 1st. This forces you to sell stocks high and buy bonds low, or vice versa, purely based on a calendar, regardless of market valuation or trend. The Weinstein insight: if the S&P 500 ETF is in a clear Phase 2 above a rising 30 WMA, the market is structurally sound. You can be more aggressive with your rebalancing, perhaps letting your stock allocation drift slightly higher than 60% because the wind is at your back. The bear market trigger: if the S&P 500 ETF breaks down into a clear Phase 4 below a falling 30 WMA, this is a major warning. This provides a systematic, non-emotional trigger to rebalance back to or even slightly below the 60-40 allocation, reducing exposure right before potentially deeper decline. This uses the 30 WMA as a macro-level risk management tool to protect the overall portfolio. The 30 WMA is not a crystal ball, but it is a powerful trend-following tool that keeps the investor aligned with the market's true direction, preventing unnecessary panic and allowing disciplined profit-taking. Chapter 4: Phase 2, the ideal time to buy. Stan Weinstein dedicates this chapter to the only phase where you should ever be a buyer: Phase 2, the advancing phase or markup phase. His message is simple: patience is not a virtue, it is a necessity. You must wait for the setup to be perfect. The Phase 2 checklist. A stock is considered a candidate for buying only when it meets a rigorous 4-part checklist. The price is above the 30 WMA. This is the most basic requirement. The price must be trending higher than its intermediate term average. The 30 WMA is sloping up. This confirms the intermediate term trend is firmly established to the upside. If the line is flat, you're still in Phase 1 waiting. If it's down, you're in Phase 4 avoid. The relative strength is improving. The stock must be outperforming the general market like the S&P 500. When the market is flat, The stock should be rising. When the market is rising, the stock should be rising faster. Improving relative strength tells you the best money is flowing into the stock, signaling institutional sponsorship. The breakout is on heavy volume. The price must have broken above a key resistance level, the ceiling of the Phase 1 base, on significantly higher volume than average. Heavy volume is the proof of commitment. It confirms that major institutional players have decided to buy the stock in size. A breakout on low volume is a warning sign of a false move. Buying tactics, the perfect entry. Weinstein discusses the two primary methods for entering a Phase 2 stock. The initial breakout. This is the most aggressive by point, when the stock first breaks out its Phase 1 base with heavy volume. The potential return is highest here, but the risk of a false breakout is also highest. The first pullback. This is a safer, more conservative entry. You wait for the stock to successfully break out, and then pull back to test a former resistance level, which should now act as support, or the rising 30 WMA. If the stock holds this support and resumes its move, the signal is much stronger. He strongly advises against buying a stock that is already at a parabolic, extended move far above its 30 WMA. The reward-to-risk ratio is poor, and you are buying closer to the inevitable Phase 3 top. The time to buy is at the beginning of the move, not the end. Modern takeaway: the growth stock paradox. Today's investors constantly pitch growth stocks based on futuristic narratives, AI, biotech, space travel. The paradox is that many of these companies have been in a long phase for decline after a spectacular initial run. The trap: an investor reads positive news about a promising biotech company that has been in a 2-year decline. The news makes them buy. However, a Weinstein analysis would reveal the stock is still below a falling 30 WMA and is showing poor relative strength. They are trying to catch a falling knife. The discipline: the Weinstein investor would ignore the story until the stock can prove it has entered a new Phase 2. This means price must move above the 30 WMA. The 30 WMA must visibly flatten, then begin to rise. The stock must show relative strength by outperforming the major biotech index. This chapter is a masterclass in patience and selectivity. You should view the market as having thousands of opportunities, but only a handful will ever be in the ideal Phase 2 at any given time. Your job is to ignore the 99% of stocks that are in the wrong phase and focus all your capital on the 1% that are ready to move. Chapter 5. Phase 3. The time to sell. Just as Phase 2 is the only time to buy, Phase 3, the top or distribution phase, is a non-negotiable time to sell and take profits. Weinstein's central warning here is that a lack of selling discipline is the single biggest reason why investors failed profit, even after being right about a Phase 2 move. Recognizing the distribution top. The Phase 3 top is often a lengthy, confusing period that tests the investor's emotions. It rarely looks like a sharp V reversal. Instead, it looks like a plateau or a sideways trading range after a significant run-up. Key signals that a stock is in Phase 3 include: the 30 WMA flattens. This is the most crucial early signal. After sloping sharply upward in Phase 2, the 30 WMA levels out. This shows the intermediate term momentum has stalled. Increased volatility with no progress. The price trades wildly sideways. It has large swings, but the high volumes are now being used by institutions to sell their shares, not to push the price higher. This is a subtle but vital psychological cue. High volume at the top is dangerous. The price crisscrosses the 30 WMA. The stock begins to trade above and below the now flat 30 WMA. This shows a loss of control and a struggle between buyers and sellers. Relative strength peaks and turns down. The stock stops outperforming the general market. This is the smart money signal. They are beginning to shift capital out of the stock and into others that are just entering Phase 2. The bust signal. The final, non-negotiable sell signal is when the stock breaks a key support level established within the Phase 3 sideways range on heavy volume. Once this support is decisively breached, Phase 4, the decline, has begun and the stock must be sold immediately. Why selling is hard: the psychology of the top. Weinstein acknowledges that the Phase 3 top is the hardest time to sell because the news is overwhelmingly positive. Wall Street analysts are raising price targets. The company is posting record numbers, and the public is fully on board. Selling feels wrong because you are selling into good news. He tells the investor to ignore the narrative and follow the chart. The time to sell is when the chart is telling you to sell, regardless of the headlines. The price action reflects the future concerns of the smart money. Modern takeaway: timing the crypto bubble burst. The cyclicality of assets like Bitcoin, BTC, or Ethereum, ETH, provides perfect modern examples of Phase 3 distribution, the trap. In the run-up to a crypto peak, the market is filled with predictions of $100,000, $200,000, etc. The news is filled with stories of institutional adoption and new ETFs. This is euphoria phase, the Weinstein signal. After a parabolic run, the price of Bitcoin starts to trade sideways in a wider range. The volume remains high, retail is buying the dip, but the price is unable to make significant new highs. The 30 WMA on the weekly chart flattens out. Then, the price breaks down below the low end of that sideways range on a volume spike. The discipline. A disciplined trader would recognize the flattening 30 WMA as the first warning, and the breakdown of the sideways support as the final, non-negotiable signal to sell. This mechanical approach removes the temptation to hold on for the next leg up based on news, thereby protecting the massive Phase 2 profits from being wiped out in the inevitable Phase 4 crash. This chapter teaches a vital truth that winning is not just about buying low. It's about selling high and being immune to the market siren song of eternal optimism. Chapter 6. Phase 4. The time to avoid or short. Phase 4, the declining phase, is the most dangerous phase for the average investor. Weinstein's primary message is simple: do not be a hero. Do not try to bottom fish. Identifying the markdown phase. A stock is unequivocally in Phase 4 when it meets two strict criteria. The price is below the 30 WMA. The 30 WMA is sloping down. This confirms that the intermediate-term trend is firmly established to the downside. The psychology of this phase is characterized by successive failures. Small rallies occur, called bear market rallies or dead cat bounces. But they all stall out as they approach the falling 30 WMA, which acts as a powerful ceiling of resistance. Each rally fails, leading to a new low and further panic. The three dangers of Phase 4. The false bottom. The most dangerous mistake for the average investor is trying to bottom fish. They see the price as cheap compared to the all-time high, or they hear an analyst say the stock is oversold. They buy, only to see the stock continue to fall, creating a sense of despair. Weinstein's rule is absolute. Never buy a stock that is below a falling 30 WMA. The trailing loss. Many investors hold a stock to the transition from Phase 3 to Phase 4, hoping it will come back. This turns a small, manageable loss into a huge, portfolio-crippling loss. Holding is not investing. It is hoping. The opportunity cost. Every dollar tied up in a Phase 4 stock is a dollar that cannot be invested in a stock that is in a new Phase 2 advance. Time is capital. The aggressive strategy, short selling. For the experienced, aggressive trader, Phase 4 offers the opportunity to short sell the stock, betting on a further decline. The best time to short is when a stock is testing the falling 30 WMA during a bear market rally, and then turns lower, confirming the downward trend. However, Weinstein warns that short selling is an advanced strategy, requiring extreme discipline due to theoretically unlimited risk. The conservative action is always to be in cash or in a Phase 2 stock. Modern takeaway: the long slide of underperformers. In today's world, many established large-cap companies fall into Phase 4 due to disruption, Netflix facing streaming competition, or secular decline, traditional retail chains. The trap: an investor sees a large, well-known retail stock drop 50% and thinks, it's too big to fail. It must be a value play. They buy, only to see the price continue to erode as the company's fundamentals worsen. The Weinstein test. When looking at the weekly chart of this retail giant, the investor would see the price has been consistently below a falling 30 WMA for over a year, and its relative strength is abysmal. The chart is screaming avoid. The price is accurately reflecting the disruption that fundamental reports only confirm months later. The discipline. The Weinstein system allows for zero exceptions. If the chart is Phase 4, it is off the list. This discipline is a powerful defense against the temptation of value traps. where a stock looks cheap but keeps getting cheaper. Phase 4 is a phase of capital preservation. By avoiding these stocks, you keep your powder dry for the inevitable Phase 1 accumulation and Phase 2 breakout, where the true profits are made. Chapter 7, Relative Strength, the king of all indicators. While the 30 WMA defines a trend, relative strength RS determines selection. In this chapter, Weinstein establishes relative strength as the single most important factor for selecting which stocks to buy from a pool of candidates in Phase 2. The concept of relative strength. Relative strength, as defined by Weinstein, is simply how a stock's price is performing compared to the general market or a relevant sector index. It is not an oscillator or a complex mathematical formula. It is a straightforward ratio. $/text relative strength equals \frac text stock price text index price $. Improving RS. If the ratio line is rising, the stock is outperforming the market. It is stronger. This is where you want to be. Declining RS. If the ratio line is falling, the stock is underperforming the market. It is weaker. This is where you avoid putting capital. Why RS is the king? Weinstein argues that relative strength is the most direct indicator of institutional sponsorship, the smart money. It reveals selectivity. In any market environment, institutions have billions of dollars to deploy. They are not buying everything. They are selectively moving money into a few strong stocks and sectors. A rising RS line shows you exactly where this institutional money is flowing. IT filters out the weak. Even in a bull market, where the S&P 500 is in Phase 2, not all stocks rise equally. Many stocks will still be in a Phase 1 base or a weaker Phase 2. A stock with poor RS is telling you that the institutions are ignoring it, making its Phase 2 move less reliable and slower. IT confirms the breakout. For a Phase 2 breakout to be a high-confidence trade, it must be accompanied by improving relative strength. A breakout without this confirmation is often a false move. Weinstein's rule is absolute. Never buy a stock in Phase 2 unless its relative strength is showing clear signs of improvement or is already near its relative high. A stock can be above its 30 WMA, but if it's still lagging the general market, it's not a Weinstein candidate. Modern takeaway, sector rotation, and ETFs. Relative strength is the core principle behind sector rotation, the movement of capital from one industry to another based on the economic cycle. The trap. In an inflationary environment, an investor might think, I should buy basic materials. They buy a large industrial ETF which is only matching the S&P 500's return. The Weinstein play. A Weinstein analysis would find that the energy sector ETF is showing superior relative strength to the S&P 500 and the industrial ETF. This superior RS signals that institutions believe the profit potential and pricing power are strongest in the energy sector right now. The investor's capital will be better deployed in the energy ETF until its RS shows signs of peaking. Phase 3. The use of relative strength in passive investing. For modern investor using collection of sector ETFs, e.g. tech, healthcare, utilities, tracking the relative strength of those ETFs against the total stock market ETF VTI, provides a disciplined, data-driven way to overweight or underweight sectors, rather than blindly sticking to rigid allocations or making emotional guesses. Relative strength is the ultimate tool for allocating capital efficiently. It guides the investor away from the story and toward the objective evidence of where the market's most powerful participants are actually placing their money. Chapter 8. When to sell. Phase 3, the most difficult decision. This chapter revisits the critical importance of selling, framing it as the most emotionally challenging, yet financially essential skill an investor must master. Weinstein provides a detailed toolkit for identifying the final, undeniable sell signals. The 3 key sell signals. The breaking of key support. The absolute stop. This is a non-negotiable final sell signal. After a stock enters Phase 3, the distribution top, it will form a sideways range. If the price breaks decisively below the low of that trading range on heavy volume, the stock has entered Phase 4, and you must sell immediately. This is the last safety net. The breakdown to the 30 WMA. The first major warning comes when the stock price breaks below the now flat 30 WMA and is unable to reclaim it. This signals that the intermediate-term trend has gone from advancing phase 2 to neutral/declining phase March 4th. This is a strong opportunity to take 50% of your profits off the table. The blow-off top. The exhaustion. This is characterized by a parabolic, near-vertical surge in the final weeks of phase 2, often accompanied by insane volume and widespread public attention. This sudden move is a sign of exhaustion, the last burst of buying by the public before the smart money completes its distribution, selling into this parabolic move. Even before the phase 3 sideways top is complete, is often the most profitable decision. The importance of selling into strength. Weinstein encourages investors to adopt a strategy of selling into strength phase 2, rather than waiting until the chart is in a clear decline phase 4. The problem with waiting. By waiting, you risk giving back all your hard-earned profits. The market will always return to equilibrium. The trailing stop strategy. He advocates for using trailing stop-loss orders, automatically moving the stop-loss higher as the price increases to protect gains. Once the stock is far up in phase 2, you're no longer concerned with your initial 10% stop-loss. You're now using the rising 30 WMA or a percentage drop from the high as your discipline. The entire chapter is a lesson in overriding the emotional bias of anchoring, where you anchor your decision to the peak price and refuse to sell at a lower price. The smart investor accepts that they will never sell the absolute top. Their goal is to sell somewhere in the top range, phase 3, protecting the vast majority of their gains. Modern takeaway. The FIRE movement's withdrawal strategy. The discipline of Stan Weinstein's selling rules has a direct application to investors in the FIRE movement, financial independence, retire early, particularly in how they manage their safe withdrawal rate. The trap. A retiree uses a standard 4% withdrawal rule, but sticks to it rigidly, even when the market is clearly in a deep phase for decline, like 2008 or 2022. They are forced to sell their assets at the worst possible prices, permanently impairing their portfolio. The Weinstein rule for withdrawal. A FIRE investor can use the S&P 500's 30 WMA as a risk-on/risk-off guide for their withdrawals. Phase 2 S&P 500 above rising 30 WMA risk-on. The market is healthy. The investor can comfortably withdraw the full 4%, perhaps taking a little extra. Phase 4 S&P 500 below falling 30 WMA risk-off. This is a danger zone. The investor should immediately cut the withdrawal rate, e.g., to 2% or 0%, and rely on a cash buffer or only sell assets that have minimal losses until the index re-enters phase 2 to benefit. This systematic approach uses the chart's objective trend to protect the portfolio from sequence of returns risk, the risk of withdrawing assets during a bear market, which is the single biggest threat to early retirement. Mastering the sell decision is not just about making money. It is about keeping it. Chapter 9, Phase 1, the base, the time to wait. Phase 1, the base or accumulation phase, is a period of transition and often an extended time of boredom. This chapter teaches the essential skill of patience, the ability to sit on the sidelines and wait for the perfect setup to emerge. The characteristics of the base. Phase 1 is a market's attempt to find its footing after a prolonged phase for decline. It is characterized by flat 30 WMA, the most defining feature. The moving average has stopped falling, phase 4, and has not yet started rising, phase 2. It is moving horizontally. This signifies that the long-term average price is no longer declining. Price crisscrossing the 30 WMA. The stock price is moving back and forth across the flat 30 WMA. There is no sustained move in either direction. Low or unremarkable volume. Trading activity is generally low, as the public is bored and discouraged. This is often where institutions, the smart money, begin to accumulate shares quietly. Poor news. The news about the company or sector is usually mixed or negative, preventing the public from buying in size. This allows the smart money to buy cheaply without causing a spike. The dangers of Phase 1. While Phase 1 is a time of accumulation, it is a dangerous place for the active investor. Weinstein gives two crucial warnings. False breakouts. A stock may temporarily break above a resistance level or the 30 WMA on moderate volume, only to fail and quickly fall back. This is a head fake designed to trap impatient buyers. Phase 4 relapse. A stock in phase 1 can still break down and relapse back into a deep phase 4. If the market is weak or the company news is bad, the selling can resume. The rule of waiting. Weinstein's rule is absolute. You do not buy in phase 1. Your job is to draw the resistance line, the ceiling of the sideways movement, and wait until the stock can break through that ceiling on a weekly close with heavy volume and a definitively rising 30 WMA. If the base has been very long, e.g. a year or more, the resulting phase 2 move is usually much more powerful. The longer the base, the bigger the move. The base is a period of building potential energy. The phase 2 breakout is the release of that energy. Modern takeaway: the long base of value stocks. In the last decade, high-flying tech stocks have dominated, leaving many solid, traditional businesses in an extended phase 1 base. The trap: a modern investor might look at an old-line company, say a major industrial manufacturer or a regional bank, which has been trading sideways for 5 years. They label it a dead money stock and avoid it entirely, assuming it will never move. The Weinstein opportunity. The long, flat base is actually a huge opportunity. The 5-year sideways movement has allowed the 30 WMA to become perfectly flat and for massive institutional accumulation to take place. An investor's job is simply to wait for the breakout. The discipline. An enterprising investor, Graham's term, or an aggressive Weinstein trader would use a stock screener to filter for stocks that are trading near a flat 30 WMA, showing a multi-year consolidation base, starting to show a subtle pickup in relative strength. The only action is to place an order just above the resistance line of the base and wait for the chart to tell them to buy, regardless of how boring the company's story is. Phase 1 teaches the investor that sitting in cash is often an active and profitable investment decision. It is a disciplined period of waiting for low-risk, high-reward opportunities to manifest. Chapter 10. Combining technical and fundamental analysis the right way. Weinstein is a devout technical analyst, but he acknowledges that fundamentals have their place. However, he flips the conventional wisdom on its head. Fundamentals should be used to filter and confirm the technical signals, not to generate them. Technical first, fundamental second. His approach is a strict 2-step filter. The technical screen, the absolute filter first. You use the 4 phases in the 30 WMA to filter the entire market. If a stock is not in a clear phase 2, you immediately discard it. You don't care if the CEO is a genius or if the P/E ratio is low. No phase 2. No trade. The fundamental review. The confirmation once a stock is in phase 2, you look at the fundamentals. The purpose is not to find it by signal. The chart already did that. But to confirm the quality of the move and to identify potential red flags that might derail the trend. What to look for in fundamentals. In a phase 2 stock, Weinstein suggests reviewing the following. Earnings and revenue. Are they strong and improving? A phase 2 breakout with deteriorating fundamentals is a red flag. Management. Is the management competent? Have there been recent, well-regarded changes or appointments? The story. The narrative. Does the narrative, the product, the service, the industry trend support the breakout? If the stock is breaking out, the narrative should support future growth, increasing the probability that the phase 2 advance will be sustained. The most crucial takeaway is the timing. The technical analysis, the chart, will often show the breakout before the spectacular earnings report or the definitive fundamental news is released. Why? Because the smart money, insiders and institutions, is often acting on whispers, internal research, or simple market efficiency before the news is public. The chart is their footprint. Avoiding the fundamental trap. Weinstein warns that if you start with fundamentals, you will inevitably fall into 2 traps. Buying too early. You love the fundamentals of a company, but the stock is still in a phase 4 decline. You buy, get hammered, and miss the actual phase 2 breakout later. Buying too late. You wait for the fundamentals to be perfect, phase 3 top. By the time the news is universally amazing, the smart money has already finished distributing, and the price is about to crash. The chart is a referee. If the fundamentals are great, but the chart is phase 4, the chart is telling you the fundamentals are either wrong, or they've already been priced into stock, and a top is forming. Modern takeaway. Bitcoin's fundamental trap. Cryptocurrencies like Bitcoin are a perfect modern example of the fundamental first trap. The trap. Proponents use a pure fundamental narrative. Bitcoin has a limited supply. It's digital gold. Central banks are debasing the dollar. This powerful, non-technical fundamental story encourages buying, even when the price is in a clear Phase 3 top or Phase 4 decline on the weekly chart. The Weinstein analysis. A Weinstein trader ignores the story. They look at the chart. If the price is below a falling 30 WMA, the correct action is avoid or short. The fundamental story, no matter how compelling, is useless until the chart shows the necessary accumulation base, Phase 1, and breakout Phase 2, demonstrating that the smart money is actually deploying capital based on that story. The discipline. The chart provides the timing, while the fundamentals provide the conviction to hold during the inevitable short-term volatility of a Phase 2 move. You are waiting for the technical signal to confirm the fundamental story. This chapter grounds the technical system in real-world business dynamics, but makes it clear that timing is dictated by the tape, not the news. Chapter 11. Trading the general market and sectors. Weinstein expands his four-phase system to analyze the entire market, using an index like the S&P 500 and specific industry sectors. He believes that the market's overall health is the most powerful determinant of individual stock success. The market-wide filter. His rule is clear. You should be aggressive only when the general market is in Phase 2. If the S&P 500 is in Phase 4, the odds are stacked against you. Even Phase 2 stocks will struggle against the overall downtrend. You should be in cash or shorting. If the S&P 500 is in Phase 2, the tide is coming in. You can be aggressive, as even slightly weaker Phase 2 stocks are likely to be pulled higher. He suggests checking the weekly chart of the S&P 500 before doing anything else. If the market is below a falling 30 WMA, your capital allocation should be highly defensive. Sector rotation. The power of the industry group. After the general market, the industry sector is the second most important filter. A strong stock in a weak sector will struggle, while a mediocre stock in a strong sector can often soar. Weinstein applies the same four-phase and relative strength analysis to all the major industry groups, e.g. technology, energy, utilities. Screen for Phase 2 sectors. First, identify which sectors are in a clear Phase 2 above a rising 30 WMA and showing good relative strength against the S&P 500. Select Phase 2 stocks in Phase 2 sectors. Then look for the individual stocks that are in Phase 2 within those strong sectors. This creates a powerful double confirmation filter. You are surfing the main market trend and the most powerful industry trend. A stock with triple confirmation, Phase 2 stock, in a Phase 2 sector, while the S&P 500 is in Phase 2, is the ultimate low-risk, high-reward trade. The power of neglect. Weinstein notes that the strongest moves often occur when a sector moves from a long period of Phase 1 neglect into a sharp Phase 2 advance. The longer the base, the bigger the move. He urges investors to look at sectors that are currently the most hated, boring, and overlooked if they show signs of entering Phase 1. When that base finally breaks out into Phase 2, the move can be immense as institutions rush to cover their underweight positions. Modern takeaway. The index fund advantage. Today, most investors don't trade individual stocks, but ETFs. The sector analysis is perfectly suited for modern ETF trading. The trap. An investor is told to buy tech XLK because it's a great long-term bet. They buy at a time when the sector is topping Phase 3. The Weinstein play with ETFs. The investor can apply the 30 WMA and RRS to sector ETFs. In an inflationary environment, the energy ETF XLE and financial ETF XLF might be in a clear Phase 2 advance, showing superior relative strength, while the tech ETF is showing Phase 3 distribution. The investor rotates capital into the strong ETFs until the chart dictates a shift. The benefit. The systematic approach allows the modern investor to participate in the powerful force of sector rotation, which accounts for a huge portion of stock returns, without having to pick individual stocks. The same simple, objective analysis, phase, slope, and relative strength, works perfectly for the general market sectors and individual stocks. This chapter ensures that the investor is always aligned with the path of least resistance, maximizing the probability of success by trading with the tide. Chapter 12, Short Selling, How to Profit in a Bear Market. For the aggressive investor, Phase 4 is not a time to sit still. It is a time to profit from the decline through short selling. Weinstein dedicates this chapter to the critical rules for this high-risk strategy. The mirror image of buying. Short selling is the mirror image of buying a Phase 2 stock. You are selling stock you don't own, hoping to buy it back later at a lower price for a profit. The ideal time to initiate a short sale is when a stock meets two criteria. The stock is in Phase 4. The price is below a falling 30 WMA, and the decline has begun. The stock is breaking down from a Phase 3 top. This is the best setup. The price has just broken the support of the distribution range on heavy volume, confirming the end of the top and the beginning of the markdown. The best shorting opportunities, the inverse of RS. Just as you want to buy the strongest stocks, you want to short the weakest stocks. The relative weakness signal. The stock must be showing poor relative strength. RS is declining and should be underperforming the general market. A weak stock in a falling market is the ultimate shorting opportunity. The failed rally. The second best time to short is when the stock attempts a bear market rally, a dead cat bounce, but stalls out the falling 30 WMA. This confirms the 30 WMA is acting as overhead resistance, and the downward trend is likely to resume. The absolute rule of short selling. Short selling is inherently more dangerous than buying because gains are capped. The price can only go to zero, but losses are theoretically unlimited. The price can rise indefinitely. Weinstein's rule for short selling is even stricter than his buying rules. You must have an immediate and rigid stop loss in place. If the stock rises and closes above a critical resistance level, off in the top of the Phase 3 distribution range, you must cover the short for a loss. Never, ever let a short trade run out of control. He also advises against shorting Phase 1 stocks, still basing, or stocks that are far below a falling 30 WMA, as they are likely to bounce quickly. You want to short the stock that is just beginning its descent. Modern takeaway. The meme stock shorting phenomenon. The dramatic rise and fall of meme stocks like GameStop and AMC provided modern short sellers with perfect Phase 3 or 4 opportunities. The trap. Short sellers nightmare the initial short squeeze, where Phase 4 stock is briefly propelled back into an insane, parabolic Phase 3 blow-off due to retail mania. Short sellers who were too early or didn't use a stop-loss were financially ruined. The Weinstein discipline. A disciplined short seller would have waited for the mania to break. After the parabolic surge, the stock would enter a clear Phase 3 distribution top. Sideways chop. The optimal time to initiate a short sale would be when the price broke decisively below the support of that Phase 3 range, confirming the start of the inevitable Phase 4 collapse, with an immediate stop-loss above the Phase 3 high. The protection. Weinstein's system would have kept the short seller out of the initial squeeze because the price was violently rising and above a rising 30 WMA, and only allowed them to enter when the technical signal at the top was confirmed, turning the chaos into a systematic trading opportunity. This chapter underscores that while short selling is a domain of the aggressive investor, it must be approached with extreme technical discipline and a non-negotiable adherence to risk management. Chapter 13, Trading the New Issues, IPOs. Initial public offerings, IPOs, are stocks that are being sold to the public for the first time. Weinstein regards them with extreme suspicion and provides a strict methodology for when and when not to trade them. The IPO skepticism. Weinstein shares Benjamin Graham's skepticism toward IPOs. They are typically brought to market during periods of high optimism near market tops and are priced by sellers, investment banks, founders to maximize their own gain, often leaving little on the table for the new public buyer. His general rule is, avoid IPOs entirely for at least the first 3 to 6 months. Let the initial speculative frenzy, volatility, and lockup expiry run its course. The 3 rules for trading IPOs. Ignore the immediate hype. IPOs don't have a 30 WMA in the first 30 weeks, making the core of the Weinstein system impossible to apply. The initial price action is driven purely by speculation. Wait until enough trading history has accumulated to calculate a stable 30 WMA. Wait for the Phase 2 setup. The first big chance, the first high confidence by signal in an IPO occurs when it successfully forms a Phase 1 base, a long sideways range, after the initial volatility, and then breaks out into a clean Phase 2 advance on heavy volume. This is the first time the market is systematically confirming a trend. Separate from the initial sales pitch, be aware of a reverse phase 2. Sometimes an IPO immediately shoots up, peaks, and then enters a long phase for decline. The real opportunity, in the spirit of value, is often when that stock finishes its phase for decline and forms its first phase 1 accumulation base a year or two later. The key takeaway is that time is the most important filter for IPOs. You let the market shake out the weak hands and let the hype dissipate before applying your rigorous phase 2 checklist. Modern takeaway: the SPAC and unprofitable tech mania. The IPO market has become a frenzy of unprofitable tech and SPACs, special purpose acquisition companies, making Weinstein's warnings more relevant than ever. The trap. In the 2020 to 2021 bull market, many unprofitable tech companies and SPACs went public with a compelling story, but no current earnings or proven business model. Investors bought immediately, driven by the lure of the next big thing, the Weinstein outcome. Most of these stocks peaked quickly, never formed a proper phase 2, and immediately entered a violent phase for decline, wiping out fortunes. The lack of a price history, and thus a 30 WMA, prevented a systematic analysis, making them a purely speculative bet. The discipline. The Weinstein system would have kept the investor out of the entire SPAC mania. The lack of a long-term moving average and a proven trading range renders the security unanalyzable by a system. If you can't analyze it, you can't trade it. The only successful strategy in that environment was to wait until those stocks collapsed, formed a new multi-month phase 1 base a fraction of their IPO price, and then look for a phase 2 breakout, a moment that came months or years later. This chapter teaches that discipline is the only defense against hype, and the best trade is often the one you don't make. Chapter 14, How to Stay Mentally and Emotionally in Tune. This chapter is the book's masterclass in trading psychology, the most critical, yet often overlooked, component of successful trading. Weinstein affirms that a systematic trading method is only half the battle. The other half is the mental discipline to follow it without fail, the trader's greatest enemy. Weinstein declares that the trader's greatest enemy is themselves. The market is designed to prey on two basic human emotions, greed and fear. Greed. The top greed makes the investor chase parabolic moves, buy stocks that are far above their 30 WMA, and refuse to sell in phase 3, hoping for one last surge. Fear. The bottom fear makes an investor sell a stock that is simply testing its rising 30 WMA in phase 2, or panic sell a stock in phase that is already deeply depressed, often just before it enters phase 1. The rules for emotional discipline. To conquer these emotions, Weinstein offers several key behavioral rules. Use stop-loss orders. This is a non-negotiable foundation of risk control. A stop-loss order removes emotional decision-making from the loss-taking process. If the stock falls by the predetermined amount, e.g. 8 to 10%, the sell order is automatically executed. You are allowing mechanical rule to override your emotional impulse to hold and hope. Don't talk yourself into a trade. If the chart does not meet all the phase 2 criteria, price, slope, RS, volume, you must not rationalize a buy. The chart is either ready or it is not. Avoid the daily noise. You must primarily look at the weekly chart to avoid the emotional swings of the daily price action. The daily volatility is noise. The weekly trend is a signal. Be a selective observer. The professional trader does not need to be in the market all the time. They are a patient sniper, waiting for the perfect, low-risk, high-reward setup. They are comfortable being in cash for long periods, which is a form of active risk management. Never let a winner turn into a loser. Once a stock moves up significantly in phase 2, you must immediately move your stop-loss to your break-even price, the price you bought it at. This ensures that even if the trend reverses, the trade cannot result in a loss of capital. Modern takeaway. The day trader's emotional roller coaster. The modern-day trading culture, amplified by social media and commission-free apps, is the perfect example of what Weinstein teaches us to avoid. The problem: day traders often focus on time frames of minutes or hours, subjecting themselves to hundreds of emotional buy-sell decisions a day. This high-frequency, high-emotion activity is mathematically guaranteed to generate poor returns due to friction, slippage, and, most importantly, emotional burnout. The Weinstein solution: By focusing on a weekly chart, the investors shift their perspective from a minute-by-minute battle to a long-term, structural trend. Their goal is to make a handful of high-conviction trades per year based on multi-week or multi-month trends, not hundreds of speculative bets per week. The discipline. The 30 WMA acts as an emotional safety blanket. When a stock you own in Phase 2 pulls back, instead of panicking, you look at the 30 WMA. If the price holds above the rising 30 WMA, the chart is telling you, relax, the trend is still intact. The mechanical system provides the emotional conviction to hold a winner and cut a loser. This chapter reminds the investor that trading success is 80% psychology and 20% system. The best system in the world is useless if the investor lacks the mental fortitude to follow it. Modern context expansion. If we could bring Stan Weinstein into the modern financial world, he would be both astonished by the tools and deeply disturbed by the psychology. His reaction would confirm the timeless nature of his core principles. Hammer and wrench, the tools of the trade, astonishment and concern. 1. The democratization of access, Robinhood culture. Weinstein would marvel at the ability to instantly chart every stock, sector, and commodity in the world for free. He would appreciate that his 30 WMA can be applied with a single click. However, his astonishment would quickly turn to deep concern over Robinhood and commission-free trading. He would see them as vehicles perfectly designed to encourage speculation over investing. Issue. The focus on the daily price and sometimes options over the weekly trend at Weinstein's verdict. These apps have eliminated the friction that forced investors to be thoughtful. They turn the serious process of capital deployment into a video game of instant gratification, which will inevitably lead to most of their users falling victim to Phase 3 and 4 traps. 2. Quantitative models and AI-based investing. He would be fascinated by the rise of quantitative quant models that use high-speed computing to scan the market. He would likely see value in algorithms that can screen the entire universe of stocks for precise Phase 2 criteria, price above rising 30 WMA, improving relative strength, breakout volume. Weinstein's stance. He would endorse the quant models that systematically apply technical analysis and risk management. He would reject models that claim to predict market prices based on complex, proprietary data sets, viewing them as another form of fortune-telling that is likely to fail when the market environment inevitably changes, e.g., when a Phase 2 market shifts to Phase 4. His system is descriptive, not predictive. 3. High-frequency trading, HFT. Weinstein would view HFT, millions of trades executed in microseconds, with disdain. He would correctly see it as the ultimate form of pure speculation with zero connection to long-term price cycles of accumulation and distribution. Weinstein's verdict. HFT is a different game entirely. It adds noise and volatility to the daily chart, further validating his insistence on using the weekly chart to filter out the short-term manipulation and instability. Chart increasing the modern strategies. Triumph and contempt. 1. Triumph. The validation of index funds, passive investing. Weinstein would wholeheartedly endorse the use of low-cost, broad-based index funds for the passive portion of an investor's portfolio. His analysis of the market's cyclical nature confirms that most investors should stick to low-cost instruments and let the market average do the work. The triumph is in how his system can be applied to time the risk allocation of an index fund. The application. Use the S&P 500's 30 WMA to determine if the time is right to rebalance or add capital. If the S&P 500 is in a clear Phase 2, a passive investor can add money with confidence. If it is in Phase 4, the investor should sit on their cash contribution or stick to automatic dollar cost averaging, but certainly not by a lump sum. 2. Contempt, meme stocks, and crypto trading. Weinstein would have utter contempt for the phenomenon of meme stocks and the speculative frenzy around most cryptocurrencies. Meme stocks, GameStop, AMC, he would see these as perfect examples of Phase 3 blow-off tops. The movement was driven by greed, euphoria, and herd mentality, with no anchor in the technical reality of the Phase 1 base or the clear Phase 2 advance. The parabolic rise and fall were pure speculation, resulting in a predictable and violent Phase 4 collapse, ruining the average participant. Cryptocurrency. He would acknowledge that crypto is a new asset class, but he would insist that the psychological cycle remains the same. The sharp accumulation and distribution phases of Bitcoin are a mirror image of the stocks he charted in the 1980s. He would maintain that if you choose to trade it, you must use the weekly 30 WMA and phase analysis as your only guide. He would view most crypto day trading as an uncontrolled, high-risk endeavor. Shield timeless principles as a shield against modern risks. In the current environment of digital noise and information overload, Weinstein's secrets become a powerful behavioral shield. Phase discipline is the antidote to FOMO. When a new IPO or a meme stock is soaring, the FOMO, fear of missing out, is overwhelming. Weinstein's system forces the investor to look at the weekly chart and ask, is this a confirmed Phase 2 breakout from a proper base, or is a Phase 3 top? The answer prevents emotional, top-of-the-market buying. The 30 WMA as the source of conviction. In a volatile market, investors sell their winners too early. The rising 30 WMA provides a visual, objective proof that the trend remains intact, giving investor conviction a hold through a natural pullback, a test of the 30 WMA, overriding the emotional impulse to sell. Relative strength counters a hype. In the age of constant hype, investors are tempted to buy world-changing companies even if the stock is lagging. Relative strength forces objectivity. A rising RS means the institutional money is confirming the story. A declining RS means the story is not being backed up by capital flow, signaling a weak trade. Weinstein would conclude that while the markets are faster and the technology is better, the core game remains unchanged. It is a battle between systematic discipline and human emotion. The simplicity of the four phases, when applied with ruthless consistency, is the ultimate way to win that battle. Closing reflection. We spent this time exploring the systematic wisdom of Stan Weinstein's masterwork, and we conclude with a philosophy that transcends decades of technological change. His system doesn't require a finance degree. It requires a chart, a moving average, and the discipline to follow the rules. Here are 10 timeless lessons for the intelligent investor. The weekly chart is your ultimate filter. Filter out the daily, minute-by-minute noise and focus solely on the intermediate-term trend, as defined by the weekly chart. Every stock is in one of four phases. Acknowledge the cyclical nature of price. The vast majority of profits are made in Phase 2, the advancing phase. The 30 WMA is your map. Use the 30-week moving average to define the phase. Only buy when the price is above a rising 30 WMA. Avoid or short when the price is below a falling 30 WMA. Relative strength dictates selection. From a pool of Phase 2 stocks, only select the ones that are demonstrably outperforming the general market. A rising relative strength confirms institutional sponsorship. Fundamentals confirm, they don't initiate. The chart provides the timing of the move. Fundamental analysis is only used to confirm quality and sustainability of the technical trend. Patience is an investment tool. The most profitable action is often sitting in cash or an extended Phase 1 base, waiting for the low-risk, high-reward Phase 2 setup to emerge. Take a loss. Don't take a hope. Use stop-loss orders without exception. Never allow a small, manageable loss to become a portfolio-crippling mistake. Hope is not a strategy. Selling is more important than buying. Do not let a winner turn into a loser. Use the flattening 30 WMA and the breaking of Phase 3 support as your non-negotiable signals to take profits. Never fight the tide. Check the general market index and the industry sector first. Only be aggressive when the major trends are aligned in Phase 2. Conquer your emotions with mechanics. The system is your shield against the emotions of greed and fear. You must allow your mechanical rules to override your emotional impulses at the precise moments when the market is testing your resolve, i.e., at Phase 3 tops and Phase 4 bottoms. How to apply these lessons right now. The beauty of Stan Weinstein's system is its simplicity and accessibility. Here's a simple, actionable plan to apply this wisdom today. Set up your chart. Use a free online charting tool and plot the 30-week moving average on the S&P 500 or your primary stock market index ETF. This is your macro filter. Adopt a risk rule. Commit to never buying a stock or sector ETF that is below a falling 30 WMA. This single rule instantly protects you from all Phase 4 declines. Become a selective sniper. When looking for new investments, screen for stocks that are in a long Phase 1 base. Then, set an alert for when the price breaks out above the base and the 30 WMA starts to turn up. Wait for the perfect pitch. Discipline your passive investing. Use the S&P 500's 30 WMA as a guide for your large capital allocations. Reduce your aggression when the market is in phase 4. Be more confident when it is in phase 2. Weinstein's path is one of systematic consistency. It teaches you to view the market not as a complicated mystery, but as a series of predictable, repeating psychological cycles. By learning to read the map, you can become the disciplined few who profit, while the emotional masses lose money, regardless of whether the market is a bull or a bear. That is a true secret for profiting in any market condition. And there you have it, the enduring systematic wisdom of Stan Weinstein's secrets for profiting in bull and bear markets. It's not just a book about technical analysis. It's a book about mastering your own emotions by letting the chart and not the chatter be your guide. It's a timeless compass that can guide you through any market storm. We hope this deep dive summary has given you a solid foundation and inspired you to think more like a disciplined sniper and less like an emotional gambler. The principles we discussed today are the bedrock of true, lasting wealth. If you found value in this breakdown of Stan Weinstein's secrets, make sure to subscribe to Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be a disciplined, profitable investor.